Okay, let's answer some questions from Sunday's Market Outlook. Now, some of these I have seen. I did answer them in the live broadcast, so I may just skip over some. Can you please talk about more about how market makers maintain their positions and handle spikes in vol, and how their delta hedging impacts markets? It's kind of a long discussion. A market maker is there to provide liquidity, right? So that's what they do by posting a bid and an ask, so that there's always liquidity when somebody wants to buy and liquidity when somebody wants to sell. For the most part, the market takes care of most of that. You don't really need a market maker to buy and sell. There could be individuals on both sides of this, and the market maker doesn't need to be there. But when participants back off the market, that's where the market maker steps in. They stand ready to transact at the bid and the ask. When stress in the market goes up, they naturally just increase the bid and the ask. Because if there's more risk in the market, since the spread is their compensation, they need to be compensated more for more risk. If it's options and you step in and you buy a call, the market maker is short the call, which means the market maker has negative delta. If somebody buys a put, you would have negative delta. If you bought the put, the market maker would have positive delta. A lot of this stuff offsets each other because they're on both sides, the calls and the puts. Every now and then their deltas will get out of line. If they've got too much negative delta, they have to buy shares. So if there is an overwhelming number of call buyers and there is nobody else offering liquidity on the offer, the market maker steps in and offers liquidity, will build a very negative delta position, will have to step in and buy shares. That's it in a nutshell, really. Analyzing GM, realized it is a good company to see how CFA into corporate investments is applied. Almost any company you can see that. I could focus not only on how to make financial model, but also choose each company where its complicity matches what I learned in CFA. In other words, inventories, income taxes, etc. So if you want to see some interesting stuff, we will be doing in the applied level this fall. We are doing one for Costco, and we are doing one for CapREIT, where we will take a lot of time on just the revenue forecast. Everything else falls into place quite easily. Like a lot of things are a function of revenue, and a lot of other line items you have a lot of the detail for already. Revenue is the big thing. You get that wrong, you get everything wrong. You get that right, you can get some other things wrong and still be pretty good. So you got to spend the time on revenue while we apply a lot of stuff from CFA. In revenue, in cost of goods sold, in SG&A, we have to model the debt. We have to model out how equity is going to evolve. We have to look at the balance sheet. We have to look at working capital accounts. We have to look at the fixed asset accounts. We have to look at, what else have we got on the balance sheet? Working capital account, cash. Cash is your last thing you look at. And that links everything together. So there's a lot of decisions that we have to make. Sound is very quiet in this one, though. I had to put it on max. Yeah, there's a couple people complaining about the sound. It's not me. I put my videos and I grab another video at random off of YouTube, put them side by side, hit play. There is no sound difference between them. I'm willing to bet it's one of two things. Either you're just poking me and seeing if you can irritate me, or it really is that you can't, that you have a sound problem. And I'm willing to bet everybody who has a sound problem is probably in the same area of the world. It wouldn't surprise me if they're using the same internet service provider with the same browser. It's something particular to your side. It's not me. I can't even tell you how much I'm doing on this end. I put my input sound all the way to the max. When I load this file into Final Cut Pro, I raise the decibel levels. It's Not me. It's not me. It's you. How would you describe your style of investing? It depends on what's going on in the market. Right now, I'm cautious. You have a market, I believe, that is overvalued, and I am cautious. I'm seeing companies in the consumer staples category that are showing signs of a consumer under pressure. I'm seeing evidence of a consumer under pressure, yet I'm also seeing evidence that the consumer keeps spending. You have conflicting data, so I am cautious. So I really do look for things right now that can hold up well if there's a sell-off. So I would say right now it's more about very deep value. I'm not interested in fair value. I'm not interested in momentum. I'm not interested in buying something that's overvalued just to sell it at an even more overvalued level. So I would never be a buyer of Tesla at 70, 80 times forward earnings, hoping to sell it at 90 or 100 times forward earnings. That would never be me. I'm more likely to short it. So I'm looking for companies that I can basically steal. That's not always the case. Let's say we have a recession, we have a credit crisis, we have a fallout, and the Fed reacts and brings interest rates down and provides liquidity to the market, and there's a couple of quarters of rough earnings, unemployment goes up to 6-7%, we start climbing out of that. At that time, I would be in heavy. I would go in heavy and hard, and I'd be looking for momentum. I'd be looking for growth because that's the environment for it. Everything would be undervalued at that point. So I'll grab the highest growth items there are. But when everything is, I shouldn't say everything, when a lot of stuff is either fairly valued or overvalued, I'm not that excited about it. You like to look for bargains, as far as I can tell. You follow the stock for a while, learn the business, learn how the stock reacts to news, and think about overreaction to share price. Yeah. You also use options to generate income and keep your beta low. Yeah. Would you say it's a quantum mental style? No, I don't know that there's much quant in there. Question with context. 30-year-old who's done level 1. Take my time to complete the other levels, but it is all in because of love of the game. Okay. Where's your question here? Your take on the future of Canada, the US, and Europe. Oh, is that all? Where governments might target the wealthy. Oh, I see what you're saying. With nearly 100K in my BKR open account for options play and a genuine love of the game, it feels like my hard work and rewards might be at risk if these policies come into play. Well, they already want, in Canada, if you're in Canada, they already want more of your capital gains. Instead of 50%, now it's 66%, so it just got less rewarding to generate capital gains than it used to be. Starting to wonder if it's worth pursuing this love of the game. If so much will be taken away. You can't really pay attention to what will be taken away, right? You can't let them win. In other words, there are ways. It would change your strategy, but there are ways to invest that are more tax efficient. I'm questioning what is the point. Well, taxes are going up. Taxes, there is no getting around it. Either debt will go up to the point where taxes are going to have to go up, or taxes are going to go up. I fear it's the first one, where debt will just continue to go up until there is no choice but to just tax anything that doesn't move, including capital. Including taxing you this year and then coming back and taxing you on whatever's left over, and coming back every year and taxing you on whatever you have left over. That's called the wealth tax, where I'll take 53% of your earnings this year and I'll come back next year and take another 2% of that earnings along with 53% of your current year's earnings, and on and on and on. So over a 20-year period, you will be taxed 93%. So you have to invest to keep returning not only inflation, but the wealth tax as well, and overcome the capital gains tax and hope you have something left. You're working for the poor at this point if we continue on. I don't know what to say to you other than they don't tax 100% yet. And once they start taxing 100%, then you can say, what's the point? What is the point of me doing anything if you're just going to take 100% of it away? So from a rational perspective, every dollar you make, you get to keep some of it, right? When evaluating utility stocks in the context of potential future rate cuts, expansion of data centers in key states, generally believe the sector has room for capital appreciation. Also worry if such news might already be priced in to some utility stocks, potentially limiting further appreciation. How someone should approach such companies in the sector, and even if the September rate cut is somehow confirmed by the market, could we expect some positive momentum in the sector after the cut? So utilities have a return on equity that is regulated and is based on what's called the rate base. And the rate base is the level of assets on which they can earn a return. So this is regulated as well. If you have a transition to less carbon intensive energy and an increase in transmission because vehicles will not be getting their energy from the gas pump but from the house, and data centers take as much energy as a small town, you're going to have to increase the assets, which mean by regulation the return on equity is 1%, right? So it'll stay the same, but the dollar value is going to have to increase, which means your dividends will increase. That's regulated. The return on equity is regulated. So utilities rarely trade at significant premiums to their value. Oh, they may trade at multiples higher than average and sometimes lower than average, but never really out of line. And if you take a 4 or 5 year approach to utilities with the reinvestment of the dividend, you'll do quite well. Won't rent continue to have massive upward pressure until mortgage rates come down? Well, it depends on what. Well, let's see if we can. I'll just draw a line here, and I'll say this is pre, and this is post. Some areas have rent control, but you can't rent control every unit, because if you did rent control every unit, there'd be no new construction. So you have to have some time period in a line in the sand saying anything built before this date has rent control. Anything after that date does not have rent control. Because if you rent controlled everything, it would be a horrific environment, because nobody would build new buildings. So this is controlled, right? So rents here can only increase so much. So if you look at the stock of all the apartment buildings, it probably looks like this, with new versus pre, right? This would be rent controlled. Wherever there's rent control, it probably looks like this. Any new builds are not rent controlled. But even in a new build, if you have a tenant in an apartment and that tenant turns over, it doesn't always turn over to market rents. Only when the tenant moves out and this is re-rented to somebody else coming in does it reset significantly higher. So it's the mix that's out there. I think what caused a lot of grief is during the pandemic, you had a lot of people leaving certain areas, going to less populated areas, so you had higher turnover than you normally would like. So some of these units turned over more than they should have, thus resetting rents higher. If you look at apartment REITs now, the amount of turnover, in other words, people moving out and people moving in, that's below 5%. Usually is significantly higher than that, because people just aren't moving. Because if they move, well, they can't match the rent they currently have. So no, I don't think that rents, on average, will continue to increase at the rate that we've seen. Some markets will. Some markets have such a shortage of housing that there is no choice. They will continue to increase. But when we talk about rent inflation, we're really talking about it on a national level across the whole country. There are some apartment REITs that are exposed to markets that are growing faster than the number of household units are growing. That will always keep pressure on rents. My personal situation, if I moved out and needed to rent my place, I locked in a 3% 30-year fixed year a few years ago and can be cash flow positive, but no owner would be paying $3,000 a month more in interest on the same property today. Make no financial sense to rent in this situation without higher rent. Not quite. Not quite. You're kind of missing the point of what's going on. It is possible to still rent at a cash flow negative level. I want you to think about $1 million property with an $800,000 mortgage, where you can rent the property, let's say for $2,500 a month, but your payments here might be $3,200 a month. You think, well, it's not worth it. It's going to cost me $700 a month to carry this place. Now, I want you to think about something for a minute. Okay, so your net is 700, right? Negative 700. But the 3,200, this is principal plus interest. So if you think about how much of this 700 is going towards principal, or the difference that you're paying, a lot of it is going towards the principal. Some of it is going towards interest. So in your first month, it might be of the 700, maybe 200 or 300 is going to principal. The rest is going to interest. But the value of this property increases over time. So if you figure out what the net interest you're paying after taking this $2,500 and applying it to all of the interest, what is left over, the $700 left over, imagine that your $700 is paying 100% of the principal plus some of the interest. Now you can calculate what your interest cost is in here, and basically you have a carry trade. You have, as long as the property is growing faster than the interest. So let's say somebody gets a new mortgage and it's 7%. After the 25 pays their share of the interest, you find that your interest expense as a percentage of the outstanding total is 2%, let's say. That means for 2%, you've bought an asset that will appreciate. As long as the asset appreciates more than 2%, you've got a carry trade. So sometimes it is worth running this at a loss. Now, you're renting it, the interest is fully tax deductible against your income. And if it's a second property, it's an investment property, you have a depreciation shield. And if you own this in your own name, not in a corporation, but you own it in your own name, you make an income from somewhere else. Let's say you make $150K a year, and let's say you're losing $20K a year with the depreciation and the tax savings. $130K is what you're paying tax on. If you were paying 40% tax because you're being taxed, you just saved 20%, you just saved $8,000 in tax, along with everything else that you're getting. You don't necessarily have to run the house at a cash flow positive basis to say that it's worth it. You can run it at a loss. If you can then take those losses and offset it against your income. And as long as the net that you're paying out on this, it is going to cost you money to hold this asset. But you can think of this $700 as, well, every month I'm going to make a contribution to my retirement account. And my contribution is $700. And your retirement account is the value of this house. Do you get what I'm saying? It's the same thing. It's the same thing. You can come out probably a little bit better on an after-tax basis. So that's what makes property so desirable to have, is because if you can rent something out, somebody basically is paying for the asset for you, and the tax savings you get can be significant against your income. Let's see. I think I've answered all of that. The owner side, the same 30-year fixed rate is keeping me from selling it too, so supply comes down, not just demand. The supply is down, significantly down, yes. How can rent inflation ever come to an end in this situation? Well, it's a tough situation to be in when you need a surplus. It's supply and demand. You need more supply than demand, right? And that means you can lower demand for rental units if the price of the substitute product declines. And that would be the monthly payment on a 30-year mortgage, which means the zero line for the Fed and 3% mortgages all over again. But There would need to be more supply of housing on the market than demand. Otherwise, the price of housing would just go up, and sure, you get a lower interest rate, but you get higher pricing. You don't need a lot of fancy thinking for this. Supply and demand. If demand is greater than supply, the price goes up. Period. How do you fix it? More supply. Which means you've got to encourage supply. You don't encourage supply in the housing sector by keeping interest rates high. You discourage supply. Rate cuts will start to increase supply. Unfortunately, they'll start to increase demand. You got to find a way to increase supply at a rate faster than demand. When the market starts to sell off and VIX spikes like it did last week, you start to sell Vega. But how do you assess if it is the event sell-off versus the sell-off of the equity market realizing recession? Wouldn't matter. It wouldn't matter. I'm not betting on the price of the market. I'm betting on the level of volatility. It wouldn't matter. Volatility spikes but comes back down very quickly. It doesn't spike and then hang out. Equity markets can do this. They usually fall like this, and then they can do this. They don't have to recover, and volatility will drop. They don't have to recover. In fact, even if the big down days are done and they just drift downwards for years, volatility will still drop. I'm shorting this. I'm not betting on this. So it just has to go sideways, and volatility will drop. The selling just has to slow down, and volatility will drop. The relationship of the dollar and the equity bond markets, I don't know. I don't know that there has to be a relationship between the dollar and the equity markets. That question is way too big, because I don't even know. I'm not even sure exactly what you have in your head when you ask that question. What specifically are you asking? Because you can write volumes on this. You can write a textbook on this about all the different theories. So I'm not even sure where I would even begin to answer such a big question. You would have to tame this question down a bit. When the VIX spikes up this high, can I use SVIX as a strategy of going short against volatility and making a profit? I don't feel comfortable selling options yet. Yeah, I imagine you could. Yeah. Recently started studying Nietzsche's philosophy and was struck by how many of my beliefs were actually imposed by others rather than consciously chosen by me. That is the danger. I mean, it's liberating, but it's dangerous, because you may come to a conclusion that what you've believed all these years was simply because this is what you were told. This is what everybody believes. This is what you were told. And you may question some of those beliefs and say, but when I really think about it, I don't really believe this. There you go. You've taken the first step to becoming what he refers to as the Übermensch, the overman, the overgoer. You're no longer burdened down by a morality that is not yours. Now, I want to be clear here. By no means was he suggesting that you have to shed morality. What he is saying is that you should not accept the morality imposed upon you. If you come to the conclusion that you should treat others as you want to be treated, if you come to that on your own, great. But if you accept it blindly because that is the morality of the crowd, he has very little respect for you. He sees that as not as a morality to raise the greatness of people, but he sees it as a morality that keeps the great down. He calls it a slave morality. So, but you can come to the same conclusions as the current morality as long as you come to them on your own. As long as you say, no, this is what I truly believe. Have you ever experienced a similar realization about certain values or moral beliefs you once accepted as true? I did. Only later reject them upon deeper reflection? Yep. Wasn't it hard for you to reject beloved values you always thought to be true? No, it was more liberating. It was more liberating. Now, it doesn't give you permission to act badly. Okay, most people think it gives you Like, oh, well, look at what it did with the Nazis, right? I mean, but that was a misreading of Nietzsche, a very bad reading of Nietzsche. Very bad reading. That's not what he was saying. So it does not give you permission to treat people badly. It gives you permission to shed those values that are not yours, and some values that are holding you back from becoming great. Or, if you have greatness within you, it may be holding you back. No, it didn't. I didn't struggle with them at all. I can't off the top of my head think of some of the things that I've rejected over time. But if I had to sit down and reflect on it and write something out, I probably could come up with at least half a dozen beliefs that I believed in before, but I've rejected. Oh, here's one that I've come to reject. We always think that if you read the New Testament, that Jesus had all this great advice for people. When you come to your own philosophy of things, as I have, I firmly believe that guy was full of bad advice. You should not even listen to that guy. He was full of bad advice, and I could probably expand on that at some later time. What's leading the CAD to trade lower in the last 2 years? Well, we have an underperforming country. We've always had a productivity problem. Canada is not as productive per employee as the U.S. because of the level of investment. It's much lower in Canada. But under the current government that we have now, policies have been implemented that are not pro-growth. They are pro-society, but not pro-growth. That's a problem. To be pro-society, you first have to be pro-growth, because if there's no growth, there's nothing. There's nothing to share. There's nothing to help out with. You cannot tax your way to prosperity, but we have a government that feels that they can tax their way to prosperity. So we lack a pro-growth policies, and we have an immigration system focused on breaking all records, because we have a prime minister who wants to be seen as the most woke and inclusive person ever, only for his own brand. I don't know that he really believes in what he's doing. But it's actually turning the country, we are converging with developing countries as their GDP per capita is rising. Canada's GDP per capita is falling. We will probably be, at this rate, unless it turns around, Canada will become the first developed country that turns into a developing country. We do not have a good economy. That's why you have the weakness of the Canadian dollar. It's mainly interest rate differential. Do you see other factors at play? I wouldn't say interest rate differentials. I think Canada's currency is weak on its own merits. Do you see tech hiring to increase notably when interest rates start going down? No, I don't think so. To increase notably? No, the tech industry is known for booms and busts in supply of labor. So let's draw this out. We'll do this. This is 1997 to 2001. This is the supply of tech. However, the supply supply of tech was going like this, but the demand for tech workers was off the charts, so the supply appeared to be low. So schools said, "Wow, let's start increasing the number of graduates we get. Let's increase our program size. Let's graduate more people." And then when there was a bust in the industry, 2001, 2000 up to 2004, 2005, you had all of these people graduating at a time when perceived supply was very high. So it actually ended up exacerbating the situation. And then, enrollment starts dropping off in those years because it's like, no one gets a job in computer science, and the next shortage seems worse than what it is. And now you have a whole bunch of departments, university departments, that have increased enrollment in data science programs. And data science certificate here, data science here, data science there. That's been going on for a couple of years. Well, 2025, 2026, 2027, when they start hitting the market, when AI starts leveling off, you're going to have a surplus of those workers yet again. So I would, in the tech space, as far as a worker is concerned, prepare for the coming bust, which it will happen. Please elaborate on how trade is essentially business margin of the PPI, because they tell you it is. That's exactly what that's what it is. I would direct you to the technical notes in the PPI release. In the technical notes, they explain exactly what that is. But the trade component is margins. So to remember now, it's PPI final demand is how much, here's a business, it's how much money the business is getting. It's how much minus tax, right? Whereas CPI includes tax. It's how much they pay plus the tax. And this is how much the business gets regardless of where it comes from, how much they get minus tax. Well, they can get more if they increase their margins. So if they increase their margins 2%, they would get 2% more, right? And PPI would have to pick that up. Why is the price increasing? So if prices are increasing, not because input costs are increasing, because margins are expanding, you could have higher PPI readings, because that is the money that they receive. The money that they receive includes the margin. So what is forcing prices up? You want to know what's forcing prices up. It could be, so that's what trade captures is. What is the value that is being received just because of the trade in what you do, not because of what it is that you're trading, but the function of trade, the service of trade. George Carlin or Bill Burr or Dave Chappelle? Why not the three? All three. I mean, I like Carlin. He was more of a social comedian, a political comedian. He was funny. Burr is just says some things that just need to be said in a way that needs to be said. He just makes fun of the ridiculousness of things. And Chappelle is a storyteller. You wait a lot for the punchline. You wait a lot, but the comedy is in the story, not so much the punchline, but he's a good storyteller. With your help, sat through level 1 exam, passed last night in plans to register for level 2, also about the applied level last month. Actually found the applied level much more applicable, useful for my professional career. As you would. That is the point of it. It is supposed to be useful for your professional career, such that when your team is given a sector or a stock saying, well, what do you think of the utility sector? Well, I don't know. You can go to the applied level. You can look at the video on the utility sector. You can watch Understanding Electric Utilities. You can look at a walkthrough of NextEra Energy, the walkthrough of the 10K. You're 80% of the way there. It gets you up to speed very quickly. And it's real world. It's not theoretical. It's not, you're not studying finance with the applied level. You're practicing finance. Would you suggest finishing the applied level? Oh, well, there is no end to it. It will just keep going. More and more will just keep being added. No, I don't know that I would say that you can finish it. Return back to the CFA track. Get it out of the way. It's the same with a university degree. You could be working and saying, I'm learning so much more on the job. Should I just quit school? Nah, get the degree. Because, that's a one-time thing, and it's done. Experience is a lifetime. But, the 3 letters that you're going to get, or the degree you're going to get, whatever education you're going to get, it's a one-time thing, and then it's over. Get it out of the way. Get it out of the way while you're young and you have ambition. Just knock it out. Right? I think SB Global, LCG, and Sector are just messing with you to get a reaction every Sunday. You think? Because it is shocking how these big data providers who charge a lot of money can't get that right. It's just shocking. Is your investing style as a retail investor essentially seeing an equity undervalued to such an excessive point that you don't need to do a deep dive on the level of institutional investor? Basically, I would caution on that I don't need to do. I do, because something that's undervalued, like a GM, for example, has been undervalued for so long. Maybe there's a reason you're just not getting. Maybe it's so undervalued you think, I don't need to do an analysis here. Look how cheap it is. But there might be a reason for it. That's called a value trap. When something is priced so low you can't understand it, you think, well, this is value, clearly. It might be a trap, because a growth stock will eventually become a value stock, and a stock on its way to bankruptcy will eventually become a deep value stock, and that then becomes a value trap before it goes bankrupt, right? All stocks pass through the deep value neighborhood on their way to bankruptcy, all of them. So you got to do your deep dive. So I wonder why this strategy isn't replicated by institutions. It is. They just do their deep dives. You have value funds and you have deep value funds. They do. How much weight would you give to each of the following explanations? Fear that if the trade goes south, you don't have very precise work done. I try not to get into that situation. Your job security is at risk. Skill level, too many opinions, biases, assets under management size. You can't allocate $1 billion with the way you trade. I could. Freeport could handle $1 billion. XLU can handle $1 billion. GM can handle $1 billion. Borg Warner can handle $1 billion. Goodyear can handle $1 billion. They can all handle $1 billion. Sure, you could. It would be difficult with positions that size to also play the options. Like once you get to a certain size, you need super liquid options. GM, Freeport, you might still get that done, but I wouldn't hold out much hope with some of the others. The balance of trade for Canada in June was 0.64. Estimates had it negative. You mentioned that is good. Anytime you have a trade surplus, you're bringing new money into the country, money that didn't exist. You previously mentioned an interesting point on why the U.S. benefits from a negative trade balance. How do you distinguish a trade balance being negative is good or bad? When it's free market, as opposed to being engineered. So if there were high tariffs on imports to engineer a positive trade balance, and it's not market engineered, it's probably damaging, right? Because I'm a business in Canada, and I can say I can get bananas from Mexico after transportation costs really cheap, and I sell banana splits. But there's this tariff on bananas that makes me buy local greenhouse bananas, which aren't that good and are really expensive. So we reduce the imports, but I got to buy these bananas. They're not that good and they're really expensive. The quality of my sundaes drops and the volume of my sales drop as well, and I'm eventually out of business because I can't make money selling banana splits with these bananas. See, that's a condition. Now, it may cost a lot more to grow the bananas here in the greenhouse versus saying, hey, Mexico, why don't you grow bananas and we'll mine gold? Because we got a lot of gold. Why don't we just do that? And you sell us the bananas and we'll sell you the gold. Does that make a lot of sense? When you mess around with the free market, you force an economy, and I gave you one example of me, but you force an economy to make suboptimal allocation decisions. Maybe it's more optimal for me to send work out of the country so that I can do more higher value work and let the lower value work be done somewhere else. But when you put a trade barrier up, now I got to do the low value work. And it takes away from me doing the high value work, which means you could see your GDP drop, even though more people are working, but more people are engaged in low value activities. So it's good when you have no trade restrictions. So Canada doesn't get involved in this tariff stuff. We have free trade in North America, and we have a bunch of free trade agreements, and It's not as if we have a lot of restrictions, so it's good. If we had a trade deficit, you could argue, well, maybe that's good too. It would be there for a particular reason. Now, Canada bounces from trade surplus to trade deficit to trade surplus. We're primarily a raw material producing country that's exporting, so it's usually more beneficial for us to have a trade surplus. But the U.S. produces a lot of intangible assets. It produces a lot of thinking. It produces a lot of creativity. It produces a lot of technology, a lot of high value added services and product that you're not going to find in Canada. So for it to run a trade deficit may be optimal, considering that it can grow at a rate faster than if it had to do all of that lower value stuff. Haven't been following too long, so forgive me if I've been asked. I'm interested in duration, and TLT is one of the best choices. How do you know how many rate cuts are baked into the price already? Well, you can look at the 20 and the 20 to 30 year segment of the yield curve, and you can look at what they're yielding, and how many rate cuts are priced in the long end is a hard thing to figure out. You can look at Fed funds futures, and you can look at how many rate cuts are priced into the futures price in terms of rates. But in terms of TLT is not going to respond to a 25 basis point rate cut if the 20 and 30 year segment of the yield curve does not move. So you have a curve that looks like this. There's your money market curve. Your capital market curve looks like this. There's the 20 to the 30 year segment. You could have rates come down, and here's your 2 year, and do this, and the 20 and 30 do not move. Then you can have rates come down again. Here's your 2 year, and you could start to have an upward sloping curve where the 20 to 30 simply does not move. So you could have rates dropping, and TLT doesn't do a damn thing because the 20 to 30 segment doesn't move. It will be affected by what's here. Now, it will, because it has cash flows all through the spot rates here. Since the spot rates are dropping, it will have a higher present value of the coupons, but the principal is way over here, and the principal, the present value, the yield to maturity you get, will be drawn heavily towards the spot rate where the principal is. So you'll get some movement, but certainly not the big movement. You need the 20 to 30 segment to drop. So how many rate cuts are baked into the 20 to 30 year segment? I don't know. Given Mag 7 accounts for a third of equity, it would be great to have a video on modeling the likes of Google and Microsoft to at least have a view on the direction they are going, if not to invest. So yeah, I think so, but you don't just jump into Apple. You got to build up to something like that. Forecasting, where especially Google is not very transparent. So forecasting where they're going becomes very difficult, because there's so many assumptions you have to make. It becomes challenging to do other than at a very high level. It's better that you get some experience with the possibilities first, looking at companies that may seem simple, where they have a little bit of intricacy in forecasting revenues, in forecasting costs. Once you have a bunch of tools in your arsenal of, okay, well, this is the type of revenue, I've run across this before, it's not very clear, what can we tie it to? What metrics does revenue seem to attach itself to? There, I think it would take some time, but I don't know that I would just jump into a Microsoft or a Google right away. We are doing Costco, and if you look at Costco's 2024 projected earnings, and you look at their EPS, and you look at their stock price, they are about 71 times 2024 earnings. Massively overvalued if you accept that is the valuation metric. So we are going to be looking at a company which I have heard it referred to before as an overvalued company. But it has a peculiarity that has to be accounted for first. So sometimes some of these companies that appear to be overvalued have peculiarities that you have to account for first. Apple, for example, you should adjust it for cash, right? Adjust for cash first. Same with Google, adjust it for the cash. Don't just take the earnings and multiply them and look at the price. Adjust the price for cash first. Some of these companies, the valuations come down. Any strong contrarian views at the moment related to the markets? I do. In other words, there's something out there you believe to be true that most people do not appreciate. Looking at the performance of the consumer in consumer staples doesn't make a lot of sense to me. When you look at GDP and the consumer is pulling in 1.68% of the 2.8% growth, you think, well, the consumer is healthy. But then when you look at consumer staples, that's telling a different story. The consumer seems under pressure. Walmart did well, but Walmart is a trade-down store, right? When you look at some other retailers that are known for, more stable shoppers, and you start seeing that average sales per shopper are decreasing, average cart size are decreasing, that doesn't make a lot of sense. Something's going on, right? So it's I think the market, or I think the economy, never mind the market, I think the economy is weaker than the data is suggesting. I think the consumer is weaker than the data is suggesting. Now, I'm not saying that the data is wrong, but something, I've been saying it for quite some time now, that something doesn't make sense to me. That sometimes, you look at one sector and you say, okay, something here does not match everything else. So it just seems odd we're trading at 21.5 times forward earnings with a consumer that is clearly weak. I don't understand. But I am building my short position more and more each day. As the market goes up, I add a little more and add a little more. I want to follow up on something mentioned in last week's market outlook. I believe there was a reference to the impact of multiple rate cuts having a negative impact on TLT. No. See below for rough summary. However, I don't expect the market to price in numerous rate cuts just yet, so I sold 102 calls at 164. I'd likely cover these before CPI. I did cover those. Okay, so there's the short term and the long term, right? Short term, there's always overreactions. We saw this in copper as well. Copper broke $4. Here's the $4 mark in copper. It bounced on 4, finally broke 4, went to 420, retraced, and then it just accelerated to 520. Copper doesn't behave that way. I am long-term bullish copper. Copper is going to find its way to $6, $7, $8 a pound. It will, but not today, right? And down it came, back to the $4 mark. TLT, the market, I think, and same thing with small caps. IWM went all the way up to 228. I took a short at 220. I didn't think it belonged there. Too much too soon. We don't have rate cuts yet, and the rate cuts needed for IWM are more than just 25 basis points in September, and of course down it came. So you have TLT that had a nice run up all the way. It got to 98. It pushed 99 for a while. I said, well, that's too much. Now long term, yeah, I think it goes above that, but in the short term, no, it didn't make sense given where we were at that time, the euphoria that we had. And I didn't feel that the sell-off that we had was the sell-off. That was a nice spike in volatility, but I didn't see it as a thing just yet. It's not the thing we're looking for. We need something bigger that persists. That wasn't it. So I just took a short on it, but a short term. Not a short, but I sold calls. Short term. I wasn't making a conviction bet. I was just saying, that's too much too soon. It's too much. So no, I don't think that multiple rate cuts will have a negative impact on TLT. I think TLT just got a little over its skis. That's all. What is your opinion on lithium market? Do you expect lithium prices to go up in the next 1 or 2 years, same way they did in 2022? In 2022, you had every car company announcing that it was going to go to EV. We're building this, we're building that, we're coming in, push over. We're going to build 4 plants. We're building a battery plant. We're securing lithium supply here, lithium supply there. We're building and on it went. To the point where, hang on a second, if everybody that announced tries to do this, it can't be done. While there's enough lithium in the world, there are not enough lithium mines in the world. And it takes a long time to bring one of these mines online. And you got to navigate the environmentalists out there, right? So, but what do we have now? We have companies saying, you know what, this battery plant we were building, let's just put a pin in that for now. This move to EV that we were doing, this aggressive move, let's kind of slow that down a bit. And you know what? Maybe hybrid. Maybe hybrid's the way to go, where you have your internal combustion engine. Instead of putting in 60 kilowatt batteries, why not put in like a 8 to 12 kilowatt battery, something with a 40 to 50 mile range, because most people just use that. Why don't we do that for a while instead of this big rush to EV? And that seems to have taken hold, right? And if that continues on, that big demand for lithium that we saw in 2022, or the perceived demand, if everybody trying to squeeze through the doorway at the same time, is not going to happen. Everyone's in single file and going through the door orderly. That may not happen. And I would not discount another technology like solid-state batteries. I wouldn't discount another technology. But I don't know that battery, full battery EVs is the solution. I think you're going to have a portfolio of solutions that include battery EV, but I also think you're going to have hybrid, right? You're going to have the new, I forget what these new things are called. They're more than just hybrid. But there's something else. I think you'll still have internal combustion that will exist for a while, along with carbon capture to support the ongoing internal combustion market. It'll be a portfolio of solutions. You know, this will be your short-range vehicle. This will be a slightly longer-range vehicle. This will be your heavy-duty and long-range vehicles in here. And, I don't see it as being a 100% battery electric future with everyone driving one of 2 Teslas. That was 2022. That's gone. That's gone, and I don't think that's coming back. Utilities, high conviction trade. I'm trying to understand the rationale. Wouldn't increased electricity demand lead to asset expansion and consequently higher capex for utilities? Yep. Which would decrease free cash flow during the expansion phase? No. The asset is called the rate base. The utility, the regulator comes in and says, okay, we approve the increase in these assets. That means you can charge this for your electricity so that you get a guaranteed return on equity. So the regulator starts with the return on equity that the utility company will get, and it builds up the income statement to get to a revenue requirement, and it says, okay, that's what you can now charge. That's what now you can now charge. Off you go. And you have a house, and I supply you with your power. I am a regulated monopoly. You have no choice. And because you have no choice, I can't set my own price. I need the regulator to do it, and the regulator does it based on the amount of assets I have. So if you believe a big asset build-out is coming, well, the utilities are guaranteed to make their return on those assets. And they do it with a combination of debt and equity. Yes, they do issue equity, and yes, they do issue debt. How do market makers manage markets like options? Okay, I already explained that. 2 weeks ago, sold 37 to 41 December put strips on GM. Okay, GM's price having increased since then. Would it be a good strategy to roll my puts higher to higher strike prices? Well, you did that because of volatility. So if you're rolling them higher, you're doing that. You're not doing that on a Vega trade anymore. You're doing that on some other kind of trade. In which case, I don't even think you need strips because you probably don't have the skew. So I don't know that I would roll forward. I would take my profit and say, okay, well, let's just sit tight. And because now it's a different trade, right? Now, if you're selling puts on GM, you're not doing it for the same reason. It's not a Vega trade anymore. It's a theta trade. So if it's a theta trade, you have to trade it like a theta trade. And you have to say, would I normally do that for just theta? So think that one through. Might be overextended beyond 48. Would selling 0.3 delta calls be a prudent strategy? I would not sell calls on GM. I just wouldn't sell calls. I'd sell puts because I think it's a buy at lower prices, but I would not sell calls because this is fundamentally not a short stock. It's fundamentally not a short. I think it's undervalued, so I would never sell calls. Question regarding valuation. Company A. I compound the cash flows at a certain rate every year for 10 years and then apply a reasonable multiple to the year 10 cash flow to arrive at the company's estimated market cap in year 10. Is this method of estimating future value flawed? Am I missing something? You're missing a hell of a lot. You're taking cash flows and you're just compounding them out. So you don't understand what's driving cash flows. You're just taking a number and compounding it out. You're not really modeling the cash flows. You're just looking at some past growth rate and saying, well, I'll just extrapolate it for the next 10 years. What drives those cash flows? Model that first to determine where the cash flows are going. So you have to figure out, well, what makes that happen? Costco's expected cash flow per share in 2030 is $30. Can I say that 30F cash flow multiple the estimated share price of Costco is 900? No. I don't know that would be a valid way to do things. Costco has cash. Costco has a balance sheet, right? Assets and liabilities, and they have long-term assets, which is property, plant, and equipment. They own 677 as of the end of 23, 677 of their locations, which is the store and the property they sit on. And then they have some land leases and then some building leases and some land and building leases. So they got a whole bunch of property of which they list at historical cost minus accumulated depreciation, right? So their asset is hugely undervalued on that balance sheet. So if you're just valuing Costco as a multiple of its cash flow or a multiple of its earnings, you are valuing the franchise itself. There's the assets. What are the assets worth? Never ignore the working capital because that's all part of generating that cash flow. But in the end, all those buildings are worth something. That if they did a sale and lease back, what would the sale generate? How many billions of dollars would the sale generate for all of those properties all over the world? If you adjust them first for the fair value of all that land they're sitting on, you might find that they would not command the same multiple of cash flow after. It's not that simple looking at just one metric. You must understand the whole business. You must understand everything about those financials so that you can say, hey, I got to pay attention to this and I got to pay attention to that. The other thing you have to be aware of is Costco has a share buyback program. But that does not mean the share count is shrinking. The share count is increasing, but they buy back shares every quarter. What's going on? How can that possibly be going on? The share buyback is in place to partially offset the share issuance from compensation. So the share count increases over time. Not as much as it would normally increase, but it increases over time. So you have to say, well, if you're looking at cash flow per share, did you model forward the increase in the number of shares that you were going to have? Right? So it's not as simple as taking one metric, looking at the last 5 years, calculating a growth rate for. If you did your analysis in 25 minutes or an hour, no way. It should take you 4 days just to figure out revenue, because there's so much you got to figure out there. There's so much you got to figure out. So many assumptions you have to make. So many tests you have to do on all of your assumptions to see whether or not you can actually recover anything. So you got to use a period of time where you have 1 year of actuals that you know, and you got to test your assumptions to see, well, will they recover the revenue for this year? Will it recover this number. You got to look at your run rate for 2024. This is stuff we're all going to do this fall when we analyze Costco and CapREIT, as I'm going to show you how to do all of these things and uncover all of the simplifying assumptions you make. And you have to start thinking about them a little bit more. But this is a rather naive extrapolation on this one, because it assumes that all Costco has at that time is its cash flow generating operations and no other assets. It's also assuming that you know what the share count is in 2030, that you have used a projected share count and not a current share count. How does a lower dollar give support to U.S. denominated currencies? Because a copper in euros, let's say that the U.S. dollar fell against euros, but the price of copper stayed constant in euros. That means it would have to be more in U.S. dollars to be the same amount in euros. So because commodities are priced in U.S. dollars, they're not going to. They may change price in U.S. dollars, but they're not going to change price in every country. They'll probably maintain their value, which means that the price of the commodity will have to go up in U.S. dollars to be worth the same in euros, the same in yuan, the same in Kiwi, the same in Australian dollars. Historically struggle with standardized tests. Although I'm very interested in finance, particularly in equity and derivatives, I'm concerned that if I fail, it might indicate that I'm not capable of succeeding in the real market. I understand this perspective isn't entirely accurate, but I can't shake the feeling. Do you have any advice on how to mentally overcome this and approach the exam more constructively? Well, I guess we first have to figure out why. Why are you struggling with standardized tests? What's the deal there? I know it can be stressful because you're going into a room and you have a certain amount of time to display what you know. But if you know what you know, put it this way: when you're in that room, you either know it or you don't. Stressing about it's not gonna do a damn thing. It's not going to change anything at all. And I know that sometimes doesn't help, but I think you would have to first of all find a way to deal with the anxiety of taking standardized tests. I don't know. I'm not a behavioralist or a psychologist in any stretch of the imagination, and I can't really speak to it because I've never really stressed out in front of an exam. I mean, sure, you're standing in the hallway, the door is closed, it's about to open, the proctors are putting the papers on the desks in the gym, and you're going to do your final exam, and you're going in, but I've always felt, I know what I know, and I have a history of doing well on exams. I don't see this as being any different, right? So if you have a history of doing well, relax. I don't know. Maybe there's a psychologist out there that's saying, "Oh, that's bad advice. He needs drugs. Can't you see?" I don't know. I guess my best advice to you is: have you always done well? And if you've done well, relax. Just relax. PPI versus CPI. How does shipping get factored in, especially when you order something and pay for shipping separately? Does the cost of shipping show up in CPI when I pay FedEx directly? Yes. FedEx would probably be in CPI somewhere. Shipping and transportation companies would be included in terms of the prices they're receiving. I'm sure it would. How did you recognize that volatility is not going to be higher again? Well, I don't know. Volatility spikes never last long. Now, volatility can spike, and you can say, aha, there's a spike, and it can spike, and you can say, okay, I'll do it again. It can spike, and you say, damn it, I'm hurt, I'll do it again. That's too much, but it always comes down fast. So you never know where the top of it is going to be, but it always comes down fast. So as long as you have the capital to survive whatever could happen, you're good. But if you see volatility spike and you say, okay, I'm all in, well, you'll get crushed if you're wrong, right? You'll get crushed. Don't get greedy. The market doesn't like that. And believe me, the market knows when you're getting greedy. It can look at your portfolio, and then everybody gets the memo that you've gotten greedy, and we all know what to do. We punish you. Everybody but you knows that you've gotten greedy. At least it feels that way. Why didn't you get into Why didn't you get into when VIX was ridiculously going to 30 on Friday? I was already doing some things. I wasn't throwing everything in. I was already doing some things on Friday, and then Monday just gave me an opportunity to do even more. I wasn't timid at that time, and entered heavy and got crushed when VIX spiked even more ridiculously higher, like 65. Yeah, there you go. You never go all. Whenever you go all in, you have to be right. You have to be right. It's better to get a taste of it and it goes away. You can at least say, well, at least I got a taste. But you take a bite. And if the meal continues on, you take another bite. If the meal continues on, you take another bite. But you got to know when to stop. Otherwise, you'll get sick. This never lasts long. It just never lasts long. So you get greedy, you get crushed. Right? Bulls make money, bears make money, but pigs get slaughtered. If the yen were to further strengthen, do you think there will be further unwinding of the carry trade? Well, it did today, but it did so orderly, right? It didn't have these sharp, big moves. It did orderly. Now, the peso obviously was the loser today, which makes absolute sense. U.S. markets were a little bit weak, which tells me that maybe some of that carry trade, some of that strength was coming out of the U.S. equity market. How much of the carry trade is in different markets? I don't know. I would say currencies, high-yielding currencies, would probably be the most sensitive to any strengthening of the yen. I would say fixed income, especially higher-yielding fixed income, would be next, but we didn't see that in the U.S. I think you saw it in Mexico. And then equities, which seems odd that you would take on two levels of risk like that, but there are crazy people in the world. I don't know if you noticed. Any idea how much of the liquidity in the market is a result of the carry trade? Oh, I already answered that. No, I don't. Can you suggest option strategies for small accounts around 15 to 30K? What stock or ETFs do you think can be used as well for the trades? You got to hunt around when you have account values that small, because you have to be willing to accept the underlying. Now, that's the way that I would measure the amount of risk that I would take on, is if it were assigned to me, could I accept it? And if you can't, all you can do is take a loss, right? You can't work your way out of it after or deal with it. But at 15 to 30, I would be looking at, if you were going to sell puts, only sell puts on stocks you're willing to own and that you can accept, which means you're not going to get greedy. You're not going to use all of your money to sell puts. Don't get greedy. You will get crushed if you get greedy. I guarantee you. Once Market Outlook has moved to your website for member-only viewing, well, it won't be for member-only viewing. It'll still be for everybody else, right? So what I plan to do is, it's on YouTube right now. And I don't know when I'm going to do this. It's certainly not going to happen for some time. Call it a year at least. But I thought of moving it to the site. And of course, you just sign up for free on the site. When you're on YouTube, I don't know who you are. I know nothing about you. I can't contact you. I can't put anything in your inbox because you don't have an inbox. But if you're on the site, it's free. You're on the site. Now if I need to say something to you because you're on the site, you have an inbox. I can just put something in your inbox so that the next time you log in, the message is right there. I don't have to figure out how do I get a hold of everybody. The message is right there. Now I know. Now I can at least reach you, right? I'm not suggesting I'm going to send you a bunch of emails to your inbox. On our site, we have an inbox. Once you are a subscriber, you have an inbox. I can send a message right to your inbox. I can post a small video. So the next time you log in, that's the first thing you see is a small video. It might be a 3-minute video telling you something. But with YouTube, I don't have very good access to you. So in time, when I feel it's appropriate, I will move it to the site, which means on YouTube, I'll put up like a 5-minute video saying the market outlook is up. I'll be talking about this, and this. Just go to the site and it's free and you'll get it. You'll be on the site. And if there's something I need to tell you, it'll be in your inbox, right? It's just more convenient. That's all. Because now it's on YouTube. I could just put it on whenever I'm on the road, but once it's moved, we will have to log in every time and click it through. I'm just not sure how well the browser supports it. Well, if it's on YouTube and you're on the road, you'd need some kind of live stream, or some kind of internet connection. Same thing with our site. It would be the same thing. It's no different. You log in, you press the video, you hit full screen, and off you go. We use Amazon AWS as the server. That should have no problem supporting you on the website. What alternative REIT would you recommend in the U.S. to follow along instead of Cap REIT? If you want to do a REIT in the U.S., do Avalon Bay. Avalon Bay is a nice, interesting one. Do that one. Now, there is a difference in the two, right? One is IFRS, one is US GAAP. It is going to create a bit of a problem, especially when it gets to the assets. Unless I haven't looked at Avalon Bay recently. I think it's with IFRS, investment property is listed at fair value, so there's no concept of depreciation, fair value gains and losses. Hard to forecast based on that, because you don't know what the gains and losses will be. You got to do some kind of analysis with the interest rate to see what the duration is. And typically, we will just assume that we have a 20 or 30 year yield. Because we have long duration assets, so we're just going to take a long duration yield and look at the change in price for the change in the yield to maturity of like a 30 year. But in the US, if you have a historical cost less accumulated depreciation, you're going to have to create a depreciation schedule and a CapEx schedule. A little bit more work to do. It gives you better ability to forecast. However, what's your net asset value? You'll know your book value, but what's your net asset value? Unless they tell you what the fair value of their properties are, you're not going to be able to calculate a net asset value. So in the US, REITs tend to trade above their book value per share. In Canada, they tend to trade, at least now, slightly below, because the book value per share is based on fair value, not historical cost minus accumulated depreciation. Look at all the stuff you learn, right? All of that stuff. Isn't that cool? But Avalon Bay. What is the benefit of Canada's mortgage structure? Beats the hell out of me. I don't know if it has a benefit, because it's hard to securitize this stuff when the prepayments can happen. Well, prepayments happen every 5 years. It's hard to securitize this stuff. It does lead to a more stable banking system because the mortgages sit on the bank's books. So the banking system is very concerned about the credit quality of the borrower. Canada pretty much avoided the mortgage blow-up in 2007, 2008 because of its mortgage system. So it sailed through rather easily. It didn't have a housing crisis like a lot of places in the world had. I'm not sure I see the benefit to consumers or banks. More of a benefit to society overall if you use 2007, 2008 as a benchmark. Is this a historical reason every 5 years you have to renegotiate your rates? Yeah, I don't know. I'm not sure what the historical reason is or how that came about. I don't know the history of mortgages. Why not switch to a structure more similar to the U.S.? I would agree. I would agree. Please advise for L3 which path is the easiest to pass. Oh, you're looking for the easiest way through? Just don't do it. That's easy. You don't need it. If you're looking for the easy way out, I imagine you're looking for the easy way out in most of everything that you do. If you are, you're never going to rise to the top of this field, in which case, why bother, right? If you want the easiest way out, just don't do it. Done. Save yourself the money, save yourself the time. Look how easy that was, right? Instead of asking which one is the easiest to pass, which one interests you the most? Which one turns you on? Which one gets you out of bed? Which one lights your fire? Which one do you think is the one that you would have the most fun with? Don't take the easy way out. Taking the easy path is a crowded path. You know why it's crowded? Because it's easy. So everyone does it. You know what's not crowded? The harder path. It's hard. That's why people choose not to do it. That's precisely why you choose to do it, is because others will not do it. Yes, it's hard work, but anything worth achieving is going to be work. Anything worth achieving is going to be work. Why take the easy way out? Take the interesting way out. What's interesting to you? That's my best answer to you. If you still want the easy way out, look, I just want to get by, then don't do it. There are other ways to get by in life. There are other ways to get by. But if your strategy in life is to get by, I have good news for you. You will get to spend the rest of your life just getting by. Stop looking for the easy way out. What do you think about the current monkeypox situation of the pandemic, or not a risk factor at all? Well, a vaccine does exist for it. So it's not as if this is new. We have no defense against it. Oh my God, what are we going to do? There is a vaccine. There is a vaccine for it. When VIX spiked at 60 or so, the next day I took advantage of this to buy some puts. Buy? Why would you buy at high volatility? I knew that IV would play significantly against me. Okay, so you did it knowingly. But I'm curious to know if there's something unique to options on VIX that I overlooked. The trade was VIX at 36 after the big spike. I bought 5 puts at a strike of 12 for 17. Expiring December 2024. This Friday, VIX closed at 14, yet my puts are only worth 12 cents. Okay, I'm not seeing what's going on here. If you're buying 5 puts, puts at 12. Okay, so to be put under 12. Well, I mean, the market is probably just saying, it's doubtful it's going to get below 12. I mean, that's... I wouldn't have sold puts. I wouldn't have bought puts. I wouldn't have bought the puts. I expected IV crush, but to this extent. Again, I'm not, I don't even, I think you were trading something you didn't quite understand. So, that's about the best answer I'm going to give you at this point, is that you should take some time to really understand how the VIX trade is set up, or how VIX itself is determined. I wouldn't have done that. If I were sitting beside you, say, here's what I'm going to do, I would have said, why? What are you doing? What do you think is going to happen? And let's think of a better way to get that done. Can you elaborate a bit on what you were doing the morning when VIX spiked? watching the options chain, jumping from ticker to ticker to ticker to ticker to ticker, looking for any kind of decent bid-ask spread where I can sell puts. That's all I was doing for like 3 hours. Market maker wasn't letting you in. Well, when you see an option and you're looking at what's a good one, SPY was a good one, even ES was a good one, but SPY, and you have it dropping significantly, and you're looking at even the 500s or the 480s, and you're seeing $5, $85. Come on. Like $5 to 80. Those are my choices. Those are my choices. Like, that's not letting you win. That's like, okay, this is ridiculous. There's no daylight between them. I'm sorry, not daylight. There's nothing but daylight between those two. They were just really wide spreads. You look at it, you go, okay, I'll come back to you in about 5 minutes. Next one. So I did what I could. Do you feel XLY reaction to retail sales performance was justified, especially given declines in key discretionary areas as sporting goods? Well, the market is trading more on a behavioral path right now. It's focused really on rate cuts. Rate cuts will solve everything. Rate cuts will fix everything. Yes, companies are challenged right now, but we got rate cuts on the way. Rate cuts will fix everything. AI, have you heard about AI? And rate cuts will fix everything. And we got 5 rate cuts, no 6 rate cuts. Maybe it'll be 50 basis points in September. That'll fix everything. And have you heard about AI? That's the narrative. That's a tough narrative to beat. That is a tough narrative to beat. So you're going against that. And if a lot of fund managers see that. They have no choice but to go along for the ride because their benchmark is the market. They got to beat the market. They got to play. They got to play. So they're in the game. They have to be in the game. They can't sit on the sidelines. They're in the game. So you get that narrative. That narrative infects all these fund managers. Prices move up. These managers have no choice but to go along for the ride, and this is what you get. Now those managers need the market to go up, so what do? They get on TV and they say the same thing. We're in the early stages of a bull market. We see tremendous pockets of opportunity in different parts of the market. The S&P x the 7 are still undervalued. They have a long way to go. There's a lot of money sitting on the sidelines. Money market mutual funds have over $6 trillion, and all the things they have to say to get everyone else listening to say, I better buy the market. It's going up. I'm missing the train. Because that's the narrative. You got to keep it going, right? So I don't, unless something fundamental shows up, the narrative isn't going to die on its own. On top of this key XLY on top of this key XLY top holdings have missed. Yeah. Well, Home Depot missed, but they went up. Which, you look at these things and you say, well, based on the narration based on what was said on the conference call about the consumer, it's like, this is odd. But yeah, when we start modeling Costco, I'm going to show you something really, really interesting. If you've ever modeled their average sales per employee, average sales per square foot, or sales per average square foot, sales per average employee, and sales per member, sales per card holder, you'll find 2023 really interesting. Wondering if it makes sense to consider an XLY short. Well, I can't say no because I am, as S&P goes up, I am shorting SPY directly. I'm shorting IWM directly. I'm shorting Tesla directly. I am, little bits. I'm nibbling. If you looked at my positions, you would say, well, you could do a lot more. I can, but I'm nibbling because I'm going in on the way up. I know I'm going in on the way up, but I am shorting it. When you say, does it make sense to consider a short? I would say, well, how much of a short? Sure, it makes sense, but how much of a short? If you say everything, no, it doesn't make sense. If you say, well, I just want to reduce my beta exposure on my long positions 10%, okay, rather than moving all of your stocks to lower beta stocks, you can simply just take a short of a high beta stock to get a lower portfolio beta. Yeah, I can see that. Crypto. You mentioned in your view cryptocurrencies are worthless or just used for criminal use. I beg to differ. There are a few serious projects like Hedera, Hashgraph, and Quant Network that are working with renowned companies and institutions. What do you think of such projects? Don't know anything about them. They don't produce revenue yet, but have working products. Never heard of them. You might be pleasantly surprised. I doubt it. I doubt I would be pleasantly surprised. I might be better informed, but I don't think I would be pleasantly surprised. I don't even think I'd be surprised. There's lots of companies working on different applications of the blockchain. Your CFA badge is on the blockchain. There are applications here and there for these blockchains. But the majority of the big one, Bitcoin is the big one. The majority of transactions in Bitcoin are for illegal purposes. Crypto enables illegal activity. It is a gift for criminals. If you didn't have a good digital world with currencies already, yeah, crypto would be a great solution, but we already have that. We already have so much of that already. That it, while there may be some applications out there, the problem here is you have infinity here. This idea that, oh, there's only a finite number. Yeah, but there's an infinite number of finite coins. There's an infinite number of blockchains. Everybody wants a blockchain. Everybody wants a crypto. There's an infinite number of them. So that's why I just don't see anything there. Now, if there was one blockchain and only one blockchain and everything happened on that one blockchain, and it was impossible to have another blockchain but that blockchain, much as it's impossible to have another treasury other than the U.S. Treasury or another Fed other than the U.S. Fed, if there was only one and everything had to go on that one blockchain, then I'd say, okay, well, we've got something. But when they can be replicated again and 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 again, not that interested. I don't think there's anything there. Continuously trading futures. What's the difference between futures traded quarterly and the continuously traded? The quarterly ones will have, if you look at a 6-month chart, it'll do this kind of thing. And then it ends. Whereas the continuously traded one is not tradable. It's just for charting. So that you can go back 5 years and there are no gaps in the chart. But the September futures contract for oil might only have trading history for the last 6 months, and before that it might be very sporadic and very illiquid, whereas the continuous contract concatenates all of the charts. You cannot trade the continuous one. You can only use it for charting. Investor sophistication versus inflation. You said it might be possible that investor sophistication reached such a degree that they would be mostly hedged against Fed inflation measures. Okay. Well, against interest rates, yeah. How could it be? Well, if you got a 3-year fixed rate mortgage for 30 years and interest rates go up, it doesn't affect you. If you have a fixed for floating swap or a floating for fixed swap and you've locked in an interest rate, or you have interest rate caps as an organization and you have floating rate debts, you buy caps and interest rates go up, not for you. Nothing happens to you. You can lock in whatever you want. Retail's also concerned. Concerned about what? What do you mean by retails? Are retails also concerned? I don't understand that. If it is not the case today, could this situation happen in the future? What situation? Yeah, I don't understand the last two questions there. CPI, PPI are really just different sides of the same transaction. Well, CPI and PPI final demand. PPI for final demand are just opposite sides. Well, nearly opposite sides. Can you help me to understand the different numbers? What factors or items can explain the difference of PPI 2 year over year, CPI 2.9? CPI is what the consumer pays for and includes tax. PPI is what the businesses receive, regardless if it comes from the consumer or from the healthcare company or from a business or from an insurance company. It's what they receive, and it does not include tax. So you could have a situation where certain cost categories are going up quickly, but that the consumer doesn't pay for those cost categories. Hospital services are a big one. Consumers will pay for health insurance. It's the health insurance companies that pay for the hospital services. That's not in CPI, the hospital service, because the consumer is not paying for it because you're measuring the consumer's price, not the producer's price. So the producer's price for final demand is what the producer receives regardless of who they receive it from. So it's just different costs, different cost categories. I did okay at the sell-off as well. Just want your thoughts on overall market leverage through options trading. What would you say the possibility of a long squeeze? A long squeeze on what? Have you experienced some market long squeeze? Long squeeze on what? You mean long squeeze? Like a short squeeze is everyone's short, so you start pushing the price up. A long squeeze is everyone's long, so you start pushing the price down. Do you mean that? I've never heard of it called a long squeeze before. Never heard of that. Short squeeze is a short squeeze because at some point you have to cover, but a long squeeze you don't necessarily have to sell. I don't know what that is. I don't know what picture you have in your head when you use the words long squeeze. Where did you find the data to calculate adjusted retail sales trends? Right in the retail sales report. It's one of the columns, unadjusted. For India equity position, do you hedge your rupee? No. Why or why not? I don't know. Just no. I don't particularly have a reason. Probably because it's not big enough for me to worry about. Do you think ON is a good stock for 68.90 short strangle? I wouldn't sell calls on it. Selling puts, sure, but I wouldn't sell calls on it because I don't want to be short ON. It's fundamentally not a short. My 10 to 20 delta theta play is doing an excellent job for the up market. I know it will be challenging when the market goes down. Could you please name some stocks for theta play so I can analyze them? You still holding long ABR 16 calls? No, 1750s. What would you do if you had a long TLT 102 January 17 call? What would I do? I don't know, nothing, I guess. I can't answer that. What did I pay for it? When did I buy it? I mean, I'd have a whole bunch of questions. It's not just a matter of what I would do. Do I own the underlying? Yeah, I would have far more questions on that one. As far as name some stocks for theta plays, I don't want to do that. I don't know anything about you. I don't know what's appropriate for you. I don't know what your risk levels are. I don't know what your level of capital is. I don't know how comfortable you are owning a particular under. I know nothing about you. So for me to tell you something, I'll pass on that. When I do the market outlook and I say what I'm doing, I say what I'm doing. This is what I'm doing. But that doesn't mean that you should copy me. I've said before, don't copy me unless you're comfortable with it, unless you've done your work and you know this is something you want to do. But for me to give you particularly advice just to you and give you some names, that's not what I do. I'm going to pass on that. We're almost done here, I think. Regarding your carry trade with the USD as a funding currency and long peso, is there a reason you use the USD instead of yen as your funding currency? Because when I short a stock, my borrow rate is 0.25%, right? 0.25%. That's all I pay to get my US dollars. That's it. So when I go long the peso, in my account, I get, in Interactive Brokers, I get a negative US dollar position. When I short a stock, it gives me US dollars today. They're restricted, but it covers my short US position. And I only pay 0.25%, which is cheaper than what IB would charge me on a short yen position. Because the borrow rate is lower than the interest rate that IB charges. So when you say money market rates are well behaved, I'm assuming that they're almost equal to short-term fund rate. Yep, pretty much. Well behaved meaning that they're just not moving. And if that's the case, what could be the implication of money market rates being significantly different than Fed funds rate? It could never be. This is the reason for an ample reserves regime, is so that they can never be different, because with ample reserves, the Fed has both the overnight repo facility and pays interest on reserves. So it doesn't have to worry about them getting out of line. They cannot get out of line, because if they go over a certain rate, you can always go to the Fed if you're borrowing for a lower rate. If they go below a certain rate, you can always go to the Fed to lend to get that rate. So you would never be motivated to go outside that rate. If rates are cut, mortgage rates significantly drop, is it possible existing homes flooding the market will take away sales from home builders? Rates would have to go down a lot. I think you'd have to get under 5%, at least under 5.5%, under 5%. They would have to go down a lot, not just under 6. We're 6.5 now. You'd have to get under 6, and I think another 100 basis points lower on the mortgage rate for that to really become a concern. What can I use instead of SPY for options? I'm worried if I get a sign I won't have 50K to cover the trade. Use MES. MES is for 50 shares. It's a futures contract on the S&P 500, and it is equivalent to about 50 shares of SPY, and it's cash settled. So you don't have to worry about anything being put to you. You previously said margin requirements for options should be most 10% of the account. Does this mean with 100K my margin requirement should always be at most 10K? Well, I don't know that that is a way that I would begin to size it. I would make sure that if you have 100,000, multiply by 0.001, and that would be the maximum theta that you should have at any given time. And that would mean that the margin would be proportional to that theta level, which would be well in the range of being able to be handled. What lessons can be drawn from Russia's failed war against Ukraine? Well, I have to accept the word failed. Russia's prolonged war, we don't know if it's failed. You won't know if it's failed until it's over. Initially, analysts predicted a quick 3-day blitzkrieg. Not only did Russia fail, but Ukraine managed to gain Russia's territories. This is not my thing. You think Kremlin's nationalistic and anti-Western rhetoric aligns with what Nietzsche would describe as herd or slave morality? No. I don't know that... there's propaganda and there's truth, right? I don't know that I would look to any politician for truth. Politicians will give you propaganda, right? And it's I think no different than what any religion would give you. It's propaganda and an ideology, but it's certainly not truth. Using futures in my corporate taxable account for passive investing and offsetting that carry with okay. They're formerly Horizon ETFs that hold a swap in cash and pay no distributions. Corporate class fund structure and the lack of an AP selling baskets to reduce premium to NAV. They're able to have all of their interest gains sit as price gains. This means that selling triggers only a capital gain. Almost sounds too good to be true, but these ETFs have been around for more than a few years. Where's your question here? Survived a regulatory attack about 4 years. How would you approach assessing regs? Oh, I don't know. Yeah, as I'm reading this, I don't know anything about these. I couldn't answer this question without doing some looking at these. I'm unaware of these, so I cannot answer this one. Next 12 months, where do you see U.S. Treasury yield moving to? Lower. I don't know where, but lower. Signed up for applied level. I'm done with 20% applied options, learning so much. Questions, where can I see your new positions on your... They don't start till September. I had no new positions in the last week, and so far this week, we're Tuesday night, I've taken no new positions because you have the Fed minutes tomorrow, you have Jackson Hole this week, and you have Powell speaking on Friday. And if he says we're not thinking 50 basis points at a time, this euphoria in this market ends rather quickly. Then I'll be thinking about new positions. But if he doesn't take that off the table and the market becomes more overvalued, I'm hesitant at this point to continue adding based on fundamentals that I'm seeing in other places. I will not go long a behavioral market. Or at least a higher conviction of long positions. So it will be in the portfolio management module beginning in September. Writing level 1, February 25, enrolled in the applied series as well, planning to land a job in asset management. Where should I start in the applied level? Sector studies. Sector studies, yes, is a great place to start. Sector studies. The PM, then applied options. I think that's a good tour. Yeah. Chinese car manufacturers setting up factories in Mexico, which could allow them to export vehicles to the U.S. duty-free. Does this lower your conviction on GM? Nope. No, it doesn't. I think it hurts Tesla far more than it hurts GM because you have to be in the market for a low-priced vehicle to begin with. You're not going to get an $80,000 truck buyer saying, oh, I can get a $10,000 Chinese car. Thank God. It's not going to happen. You're not going to get a Corvette or Cadillac buyer suddenly saying, oh my God, they're here. But you will get people who say, I'm looking for an EV and a pure EV, and here's an alternative to Tesla's two cars. And they look better, and they drive better. So it would affect Tesla far more than it would affect GM, because GM just doesn't have a big enough foot in that space, and their customers are not looking, number one, for a $15,000 or $20,000 full EV. So yeah, I'm not going to say they'll be unaffected at the margin. It's going to affect them at the lower end, but at the lower end, margins are usually thinner, much thinner. Tesla will get hurt far more than GM will. Do you see American automakers able to maintain competitive advantages given Chinese car offer similar features at significantly lower prices? I don't know that I would say they offer similar features at significantly lower prices. They offer, it's basically, you can call it a new class in the lineup at the very lower end in terms of affordability. And again, GM really has pulled back on the EV side of things. Still moving into it, but has pulled back. Mostly selling higher priced, higher margin vehicles at this point. I don't know that the U.S. government would allow Chinese manufacturers to have a Mexican backdoor. I just don't see it. It's either you set up a factory here in the U.S. like Toyota does, or Honda does. You set up a factory here and we'll talk about it. Does Trump claiming that he would welcome Chinese companies to set manufacturing in the U.S. pose a risk to GM? Still no. No, I don't think so. No. Well, from what GM sells and where it makes its money and what the Chinese manufacturers sell and make their money, there's very little intersection. But that doesn't mean that intersection set couldn't widen, and there would be issues. So I'm not going to say no forever, but as of right now, no. Maybe in 12 months, I might say, something to think about. Maybe in 24 months, it's like, okay, this is, the locals are getting killed. Maybe. Follow a few YouTubers who seem to have the mass majority of their wealth tied up in collectibles, sneakers, baseball cards, etc. So much stuff they pay for storage lockers. Is this a sneaky good way to build wealth, or just a product of American consumerism? Collectibles are a big thing. I think any business is a way to build wealth, and if your business is buying and selling collectibles, buying them, owning them for a period of time, selling them at a gain, I think that's a way to build wealth. Running a YouTube channel and having a bunch of followers and monetizing that YouTube channel is a way to build wealth, because where are you going to get your customers? From your YouTube channel, right? Given your view of Trump as a vindictive autocratic figure, it may be that for Trump it was important to beat exactly Biden for 2020. Now that Biden is out, he may be less interested in competing for the presidency. Oh, I don't think he's less interested. He's got a lot of scores to settle. He wants the power. He wants the power, period. And he won't lose. He won't lose against Harris. He'll win, or the election will be stolen from him. You know this. I mean, you know this right now. He'll either win, or the election will have been rigged. The election will have been stolen from him yet again. You know this is the outcome. I mean, there's only two ways it can go. Harris will not win. Either Trump wins, or it was stolen from him. Period. My observations are likely premature, as they are based on a subjective sense of the decreasing heat against Kamala and Trump's weakening PR. Yeah, he needs to come out with something strong, because I don't think it's Kamala Harris that people are drawn to right now as much as her VP pick. He seems to be just such a great guy. He seems to be kind of a guy you can get along with. That he just, I don't know, seems like a no-nonsense kind of decent, straight-up guy. He seems, I think, give him more airtime, give him more, more coverage. And this is something I don't think that the Trump team can beat easily without I don't know, lying. I think J.D. Vance is a problem. I think he's probably been a disappointment to Trump so far. Look for him to be pushed to the back, out of the spotlight, asked to shut up. But yeah, they've got to come out with something. But there's no point doing a big spend right now with the Democratic convention going on. She's going to get a bump no matter what. No matter what, she's going to get a bump. But there are some leaks out of her campaign that behind the scenes things aren't that great. That the polls, there's some recognition that the polls are actually overstating her popularity. So I think the Trump team should hold back their money and keep quiet till this week is done, because why fight the inevitable? She's going to get a bump. She's going to get a bump, period. Why fight the inevitable? And then come out next week and be reasonable, right? Quit talking about her skin pigmentation, for Christ's sake. Like, that's not getting you anywhere. Be reasonable. Hit her with the economy. Hit her with the border again and again and again and again. Remind everybody that she is more left of Bernie Sanders. Remind everybody of that. Remind everybody that she wants price controls, that she wants to implement communist policies. Hit that again and again and again and again. That's how you beat them. But I don't know. Not sure if I missed the announcement or not, but no new positions this week. I already answered that one. Financial modeling thing, paid or free. If you have the applied level, it is included with the applied level. We are starting with 2. Again, Costco and Capri. All right, and that is the beginning. There will be more, and they'll all go in the sector studies in their appropriate sector. I suggest you raise the volume in the videos you uploaded. I suggest you shut up. That's a good one, eh? I think I already explained that. This one's even more difficult. I think you're poking me. Or again, I think you're all probably in the same area. Maybe you do have a legitimate problem, but I think you all share the same technological problem. Last week I asked look at this, we're at the end. Last week I asked a question, how I could be a master in finance. You gave me a good answer. But I want to know, is it really a good aim to have? Yeah. To be great at something? It's a damn good aim to have. Or what aim should I have? Well, you've got to figure that out for yourself. That's a journey. That's the journey of life. That's the journey of your 20s. Is you figure it out. I want to be really knowledgeable and also benefit from that knowledge in real life. Well, okay. Then yeah. You know, I mean, if are you asking, should I be a master in finance or do something else? I think that I don't believe that there is one calling for everyone. That you missed your calling. I think if you have the fight in you, that almost anything you do, you will rise to it. There are lots of interesting things that I could do. There's lots. Finance doesn't have to be my calling. There could be other things that I would be equally aggressive with and ambitious with. And there are some things I want nothing to do with. So I don't know that you have just one calling in life, but your calling should be about meaning, not exactly what it is that you're doing, but is what you're doing providing you meaning in life? Does it get you up? Does it get you excited? Right? Do you have an opinion on loan originators like United Wholesale Mortgage Company or Rocket? I've heard of Rocket, Michigan company, I believe, and of real estate listing services like Zillow or Redfin. They also seem strong plays with interest rate cuts on the way. I heard something on Redfin a little while ago. There was some issue there with Redfin. I forget what it was. I didn't pay attention because I'm not really into these things. Well, loan originators will do well as interest rates go down. What loan originators need are mortgage applications. So rising mortgage applications, which means you need lower and lower and lower rates. But here's the thing. Let's say you get a rate cut in September and the Fed signals more rate cuts. If I'm a home buyer, I'll wait. You're not going to get a spike in mortgage applications on one rate cut. This is what we have in Canada right now. Buyers are on the sidelines. Why? Because everybody expects 2 more rate cuts from the Bank of Canada. Well, if there's another 50 basis points, I'll wait till December. I don't need anything right now. I'll wait till December if there's another 50 basis points. So it could be sort of an inverse play here in September when Powell cuts and says, okay, we have confidence, we're going to start the rate cutting cycle. And if there's a belief that, well, rates are going to drop 100, 150, 200 basis points over the next 12 months, as a buyer, you would say, you know what, I can wait a little bit longer. I'm still getting good money in the money market. On my down payment, I can get another, I can lock in 6 months right now at 5.25%. And if rates are going to be 100 basis points lower in 6 months, I'll wait. It could cause buyers to pull back even more. But if you said rates are never going down, they're going to stay right here, as a buyer, I would say, I guess I got no choice, right? So the moment you start the rate cut, you could actually push all the buyers to the sideline and cause the housing market to drop even further. Instead of helping the housing market, it could actually hurt the housing market until the rate cuts are done. So flip a coin on this one, right? Anyways, that's a wrap.